Okay, so many people ask me, what is a certified mortgage planner? You guys hear me talk about it all the time that less than 1% of loan officers are certified mortgage planner. What is that? Well, this is what I'm going to show you. So basically what we're looking at is when a client goes under contract, I'm monitoring the bond market, which is this behind me, which is how I know how interest rates are trending. In fact, if you're working with a loan officer or you have a loan officer partner, and you ask them what are the three primary economic factors that cause interest rates to go up and down, because they need to know that if they advise you on when to lock your interest rate. If they stutter or backpedal or don't tell you right off the cuff what those three are, you're not working with the right partner and you're not hiring the right loan officer for your loan. So a certified mortgage planner looks at a total planning approach. We use software like this, and I'm going to walk you through an example. Every single one of my clients gets a certified mortgage analysis because the lowest interest rate doesn't always make the most financial sense. Yes, I said it. I know we're programmed to think that that's the case, but when you take a planning approach, I'm going to show you why that's not. So here's an example. We've got 4 different interest rate options. This is just hypothetical. No RESPA and the CFPB. I'm not quoting any kind of rates. Just giving you an example of what a certified mortgage plan looks like. So, for example, we're going to show 4 different interest rate options, a 4.875, 4.7, 4.6, and 4.5. Then we've got the monthly payments listed here. And what's interesting is each dip, so at the 4.875, the monthly payment's this. When you get a little bit better interest rate, it lowers the payment $18.27. Do you see that? This is an important number to know because each change in the rate is going to lower the payment $18.27. That's it. So what's important that we analyze is what is the cost for that rate, because every interest rate has their own DNA makeup of the rate. Usually the lower the interest rate, the higher the cost. And there's 30 components we look at. Go to my website, yourmortgagenerd.com, and click on mortgage rates. I show you what those 30 components are that go into your rate. It's not just credit score and it's not just down payment. That's 2. There's 30. And some of them you can't control, like the type of home that you're buying or the county you're buying in or whether or not you have a HOA or not. So when we look at this, the example we're using here is the funds for closing for this first option, the highest rate option, which is everyone's like, why in the world are you showing me this? I don't want this one. I want the lowest. Well, I'm going to show you why. So this interest rate of 4.875 means total funds to close with down payment, closing costs, everything, was $12,019. The next best interest rate we know is going to save them $18 a month, but it jumps your funds to closing up $800. A little bit more than that, but let's just be conservative, $800. So is spending $800 of your liquid cash today make more financial sense to save $18 a month? Well, how many months do you have to save $18 a month to recoup that $800 investment? So for all those who aren't math nerds out there, you would take the $800 or the difference and you divide it by $18.27, and it basically gives you 44 months. So what this is saying is that it's going to take you 44 months of saving $18 a month to recoup that upfront investment. And the reason why the lowest interest rate doesn't always make the most financial sense, even though our parents and grandparents tell us that, is because they stayed in their homes for 30 years. So yeah, if you pay interest for 30 years, it's going to make a lot more sense. But the NAR statistic is that on average people stay in their home anywhere between 5 or 6 years before they sell or refinance. So this is why we got to run the numbers. The 4.625 jumps up less than $800 more, but it's $13,344, and then this 4.5. But here's what I look at. So this calculator here, it's labeled your savings over 84 months. I call it the rate of return calculator because what we do is we fast forward you with each option 84 months. Why 84 months? Because we want to over-exaggerate the average of how long someone stays in their home. We don't want to look at 30 years, so it's going to over-dramatize the savings. So I look at 84 months. We can customize this. But we calculate to the penny what the total amount of principal and interest that you're going to pay with each option over 84 months. So if we're comparing FHA versus conventional or VA versus conventional, we can literally calculate it to the penny and we don't have to guess which one makes the most sense. Because when you make an emotional decision with finance, it's usually not a good decision. You want to make a factual one. So I give you the facts and the numbers and it makes it super easy. So we calculate total principal and interest, total principal, remaining balance, what your total interest and mortgage insurance is, your tax benefit, all that good stuff, and then it gives us your net savings down here. And that's what populates on this bar chart in orange. So what this is telling us is that, for example, if we compare everything to the highest interest rate option, if you took $800 and you brought it to closing and you saved $18 a month, then at the end of a long 84 months, you would have only made a rate of return on that investment of $756. That's it. Does that make sense? Is that rate of return good? Could you put that in a savings account that compounds monthly, and would you have more money at the end of 7 years, or with your financial advisor, or put it in your 401k? Or, most importantly, for this particular client, this was their scenario. So you can see here that they've got student loan debt, they've got some credit cards, they've got more debt here, installment loans, credit cards, and more revolving debt. So if I took that $2,000 difference from option 1 and 4 and paid these 2 credit cards off that charge you interest every day, it's probably in the high teens of interest, basically it's costing you more money to borrow money on that credit card, and that credit card's not tax deductible, than it is on your mortgage. So when you're working with a certified mortgage planner like myself, we're looking at where's your dollar going to stretch the most. And that's what is super important to me. That's what I'm passionate about. That's what gets me out of bed is, I started my first business when I was 15. I learned at an early age how to make your money work smarter, not harder. When you come home and all your stuff's on the front lawn because your house got foreclosed on, you learn really quick that this world revolves around either working really, really hard to put food on the table or being really smart and strategic with your money. And that's what I am most interested in. And I feel like our schools don't do a good job teaching us that. Our parents only know what they know. They grew up in a different time. So my responsibility, if I'm going to put you in probably the biggest debt of your life, I got to teach you some skills to get yourself out of debt and make your money work smarter. So for those of you who didn't know what a certified mortgage plan is, hopefully you now have a better understanding. Again, every single one of our clients gets these when they go under contract, and then every year we'll present one to you on the anniversary of closing on your home, so we can monitor your equity position and ultimately help you make more money for your next home purchase. So thanks for watching. If you guys have any questions, you know how to get a hold of me. All of my contact information is on the homepage of my website. You can call, email, text. You can even book an online appointment. So thanks for watching. If y'all need anything, give me a call. Bye.